If you have money sitting in a regular bank savings account right now, it is worth asking a question. Is your bank actually giving you a fair return on your savings? Most traditional bank savings accounts pay somewhere between 0.01 and 0.05% interest per year. On a $10,000 balance, that works out to somewhere between $1 and $5 a year in interest. Meanwhile, a category of account called a high-yield savings account is widely discussed in the personal finance community as paying anywhere from 4 to 5% or more on the same balance. That is the difference between $5 a year and $500 a year on the same $10,000. Today we are breaking down exactly what a high-yield savings account is, how it works, and what people commonly look at when comparing options. Intro. Welcome to Yield Report Daily, where we break down personal finance in plain English. No jargon, no financial advice, just clear education you can actually use. Everything in this video is for educational purposes only. We are not financial advisors, and nothing here is a recommendation to open any account or take any action. If you are new here, subscribe because we publish a new video every week. Now let us look at what high-yield savings accounts are and why they come up so often in personal finance discussions. Section 1. What is a high-yield savings account? A high-yield savings account works the same way as any savings account. You deposit money. The bank holds it. The bank pays you interest on the balance. The key difference is the interest rate. Traditional big bank savings accounts have historically paid very little. High-yield savings accounts, which are typically offered by online banks and newer fintech companies, have been able to offer higher rates because they carry lower overhead costs than traditional banks with physical branches. The interest rate on a savings account is expressed as an APY, which stands for annual percentage yield. This is the percentage of a balance that would be earned in interest over a full year. For example, at 5% APY on a $2,000 deposit, the interest earned over a year would be approximately $100. That amount is credited to the account automatically, usually on a monthly basis. Section 2. Why traditional banks pay so little. Understanding why traditional bank savings accounts pay almost nothing helps explain why high-yield accounts are discussed so frequently. Large traditional banks have enormous fixed costs, physical branches in every city, thousands of employees, legacy technology systems. These costs mean they do not need to compete aggressively for deposits by offering high interest rates. They already have millions of customers through sheer convenience and brand recognition. Online banks and fintech companies operate with far lower overhead, no physical branches, leaner teams, modern technology. They use the higher interest rate as their primary way to attract customers because they cannot compete on the number of ATM locations or decades of brand familiarity. The result is that many online banks pass more of the interest earned on deposits back to account holders. Section 3. FDIC Insurance and Safety. One of the most common questions about high-yield savings accounts is whether they are safe. In the United States, most high-yield savings accounts offered by legitimate banks are insured by the FDIC, which stands for the Federal Deposit Insurance Corporation. FDIC insurance covers up to $250,000 per depositor per institution. That means if an institution were to fail, deposits up to that amount are protected by the federal government. This is the same protection that applies to deposits at traditional big banks. Before opening any savings account, it is worth checking whether the institution displays FDIC insurance status clearly. Reputable providers will show this prominently. Section 4. What people look at when comparing options. When people in the personal finance community discuss how they compare high-yield savings accounts, a few factors come up consistently. The first is the APY rate. This is the most visible factor, but rates change over time based on the broader interest rate environment set by the Federal Reserve. A rate that is competitive today may be different in 6 months. The second factor is fees. Many high-yield savings accounts have no monthly maintenance fees, no minimum balance fees, and no transfer fees, though this varies by provider, and it is worth checking the specific terms of any account. The third factor is minimum balance requirements. Some accounts require a minimum deposit to open or a minimum balance to earn the advertised rate. Many widely discussed options have no minimum at all. The fourth factor is transfer speed. Since online banks do not have physical branches, money moves in and out through electronic transfers, which typically take 1 to 3 business days to process between institutions. Section 5. High-yield savings accounts versus other options. High-yield savings accounts are widely discussed as a common consideration for emergency funds and short-term savings, but they are not the only option people explore for accessible cash. Certificates of deposit, commonly called CDs, are another option that sometimes offers higher rates in exchange for locking money away for a fixed period. Early withdrawal typically comes with a penalty. Money market accounts are another variation that sometimes includes a debit card or check writing ability, offering slightly more flexibility. High-yield savings accounts sit in the middle of this spectrum. They are generally discussed as offering better rates than a regular savings account and more flexibility than a CD. They are not investment accounts. The money does not go into the stock market, and the balance does not go down due to market movements. For people thinking about where to keep an emergency fund or savings needed within the next 1 to 3 years, the combination of accessibility and rate stability is part of why they come up so often in these discussions. Section 6. Commonly discussed providers. Several providers come up consistently when people in the personal finance community discuss high-yield savings accounts. SoFi is one of the most widely mentioned, known for a competitive APY and no minimum balance requirement. Chime is another frequently discussed option, noted for its app experience and no fee structure. Marcus by Goldman Sachs is often mentioned as a well-established option from a recognizable financial institution. Ally Bank has appeared in personal finance discussions for years as one of the earlier online banks to offer competitive savings rates. Links to explore these options are in the description below. As always, these are affiliate links, meaning if an account is opened through our links, we may earn a small commission at no cost to you. All rates and terms are subject to change, so always check the provider's website for the most current information. Whether a high-yield savings account is worth exploring is a question that comes up a lot in personal finance discussions, particularly for people thinking about where to keep an emergency fund or short-term savings. The core point that gets raised is a simple one. Traditional savings accounts and high-yield savings accounts are both federally insured deposit accounts. The main difference is the interest rate, and that difference can be significant over time. Links to the providers mentioned are in the description. If this was helpful, subscribe to Yield Report Daily. We post a new personal finance video every week in plain English. And if you have not yet looked into building an emergency fund, that is a natural starting point for understanding how much you might want in a savings account in the first place. Link to that video is on screen now. See you in the next one.